For the market structure, we want to see the trend. The market structure, the trend is the direction of the market. So we're looking at higher highs and higher low. Higher highs and higher low. This is a breakout structure, also known as the higher high. This is a breakout structure, also known as the higher high, whereby this is the higher low and this is the higher low. So if the trend is going down, creating a new lower low and lower high, this is a breakout structure, which is a lower low. This is a breakout structure, which is a lower low. This is a breakout structure, which is a lower low. And this part here is a lower high. This part here is a lower high. And here, right here is a lower high. Okay. In a situation where you have the change of character, or you have the swing point, or you have the ranging trend. The change of character is when you're going uptrend, you want to see the chart canceling out the most recent higher high and higher low. So this candle or this trend is the change of character. The ranging trend goes this way. Sometimes it can go horizontal, we're creating support and resistance. The price is not going past it and the price is not going below it. You need to be very careful when you see something like this. One other key thing you need to understand is the swing points when the price is creating highest point of reversal and lowest point of reversal. The highest point of reversal and the lowest point of reversal is still the same, the higher high at this point for the uptrend and the higher low at this point for the uptrend. This is the higher high, this is the higher low. So the higher high is a swing high, the higher low is a swing low. For the downtrend, creating a new lower low and lower high, the lower low is a swing low, the lower low is a swing low, whereby this point is a swing high, here is a swing high. How do you know that this is a fair value gap? A fair value gap is a zone that skips the price, meaning the price didn't trade fairly at that zone. So when you have a candle that are consecutive, it could be bullish, it could be bearish, and you notice that there's a gap in this point, meaning there is no candle crossing it. Okay, so when you notice that there's a gap in that point, this zone is a fair value gap. So if there's a bullish fair value gap, that means that we have three consecutive candle, candle 1, candle 2, and candle 3. These are the three candle, this is the 2 candle, and this is the first candle. So for bullish, we're looking at the price, provided it is pushing to the upside, there will be a retest into this zone before pushing to the upside of the chart. All right, and if it is a bearish fair value gap, I notice that the candle is giving a space for this candle 2, we're looking at selling in the fair value gap zone to the downside, because the fair value gap always tests the zone. All right, SMC come to the zone to test the price. All right, so how do you know that this is an order block? An order block is a last bullish candle or the last bearish candle before the downward push. So if you're going uptrend and you notice consolidation, or you notice series of trend coming down here, there'll be a last candle you will notice before the downward push, because at this zone the price is very, very expensive, meaning that nobody wants to buy again to push the price to the upside. Okay, and at the bullish side you can have series of candles creating consolidation, or creating series of candles like this before pushing to the downside. There will definitely be a zone at this point which is going to push the price to the upside of the chart. So the last candle at this point that creates that upward push, the upward push could be a fair value gap, which is an imbalance, or you can have a clear out before a candle before the candle that pushed to the upside. So the last candle is going to determine if that area is an order block or not, because in the future the price is likely to come to test the zone and push to the upside. Similarly, if you see the zone at the upside of the chart, the price is likely to come to test the zone and push to the downside, because we always want to buy when it is very, very cheap and sell when it is very, very expensive. In liquidity, we're looking at the equal highs and equal low liquidity, meaning the price creating a high at this point, and we have series of candles shifting to the downside. Immediately we get to a retest at this high side of the chart, we're looking at to sell. That's the equal high liquidity, whereby the equal low liquidity in this situation is the opposite of the equal high liquidity, which is the buy side liquidity. We have the first test to the downside, series of candle creating liquidity at this point, then it meets at the zone, and boom to the upside. This is a buy side liquidity, and the upside here is a sell side liquidity. Okay, the next one I'm going to show you is going to be the supply and demand. When you have a chart and you see the supply and demand, you might not know that it's the supply and demand. All right, the supply and demand is a zone where the price is very, very expensive or very, very cheap. So the price of the chart is at this zone because you have series of candle going to this part, coming to this part, meaning the price is very expensive. All right, so at this point, you're willing to sell to put the trend to the downside of the chart, and coming to the downside, we're looking at to buy again because the price is very, very cheap. Technically, these are the chart works in the trade because we're looking at to sell from the zone, looking at to buy from the zone. That's how supply and demand works, because supply zone is the area that the price is very, very cheap, while the demand zone is the area where the price is very, very expensive.